Get into it. So hello everyone, my name is Katrina Love. I am the Program Assistant for the Physician Recruitment and Retention Program for the Nanaimo Division. I would like to first acknowledge with gratitude that most of us are calling in from the unceded and traditional territories of the Nanaimo people. And then so on behalf of the Nanaimo Division, I would like to welcome everyone to our monthly Business Insight series. I would like to introduce you to your hosts today. So we have Marley Chesson and Curtis Basica. Hopefully I got that right. Marley and Curtis are business advisors with MNP's professional service team on Vancouver Island. They're based in Nanaimo. Marley and Curtis work with doctors, dentists, and lawyers to deliver advice and solutions tailored to their unique challenges and objectives. They specialize in startup planning, taxes, growth, right through to succession. So welcome, Marley and Curtis, over to you.
Thank you, Katrina. So thank you so much for having us, and thank you to the division. Welcome to our first session of our Business Insights series. I'm just going to start off with a couple housekeeping items. So the session is being recorded, so feel free just to sit back and listen. We will send you out a copy after the session. And we will have questions that can be posted in the live chat. So at any point, please post a question. We're going to try and address all the questions at the end in a Q&A session. And at that time, even too, when we have our Q&A, feel free to unmute and ask a question. So the fun part of this is we also have a draw at the end of the session for this awesome Vancouver Island local box there. So please stick around. There's some great stuff in here, some local coffee, beer, ciders, chocolates. So you guys will all be entered to win that.
Awesome. Thanks, Marley. The topic today is financial planning, common pitfalls, and how to avoid them. So through our work with our professional clients, we've kind of came up with a list, obviously not fully inclusive, but some of the things we're going to be touching on today is poor tax and financial planning. So making sure you're getting that proper tax advice when you're starting out or midway through your career, or even as you're winding down. Lack of legal advice, using lawyers and utilizing their skills with, shareholder agreements, lease agreements, cost shares, and different things like that. Poor investment decisions, trying to hit a home run per se. Obviously, if it's too good to be true, it probably is. Personal spending, spending to the point where, your personal debts aren't paid or you're not planning for certain tax bills that are going to be arising. Non-existent or poor retirement planning, not setting aside the adequate funds for RSPs or TFSAs, or utilizing different investment tactics. Not running your practice as a business. Good operators pay attention to the processes that allow for profitable operations, making sure you're aware of your overheads, your liabilities, and just monitoring your revenue and things like that. And last but not least is just making sure you stick to your knitting. You're all professionals in the doctor and physician world, so you are the best at that, and you're not ideally the ones who is going to be making the wisest investment or tax decisions, but you are going to be the best ones to help in any medical way.
Great, thank you, Curtis. So today we have 3 guest speakers to help us recognize these pitfalls and give us some tips and kind of examples of how we can avoid them. So today our guest speakers, we have Greta Johnson, financial planner with RBC, and we have Alana McLennan. She is a tax specialist at MNP, and we have Nathan Seward. He is a lawyer with Heath Law. So I'm going to give each of these guests an opportunity to speak to how they can support a physician in their business and how they can help to avoid these common pitfalls. Greta, I'm going to pass the floor to you. Feel free to give us a little intro to yourself and an insight into your role as a financial planner.
Absolutely. Thank you so much. Happy to be here today. Appreciate the invitation. I am a financial planner here in Nanaimo. I have been in the industry for 20 years. I started when I was 20 and I'm 40 now and totally stressed about it. So I'm just going to leave that out there. The more I say it, the more I come to grips. So, but have been in the industry for a while and started specializing on the financial planning and investment and savings part of the business right before the global financial crisis in 2008. So have got quite a bit of experience, I feel like, in the last 12 years. So I just wanted to lead with, why would you work with an advisor? As Curtis mentioned, one of the pitfalls is just not having one. When we look statistically at the households that are working with an advisor, what we're seeing is that we're seeing more dollars allocated to savings. We're seeing those savings earn higher rates because they are getting actively managed and advice on a more regular basis, which ultimately is leading to a greater net worth for those households. On the last reports that we have over 15 years, that period is showing a 4 times higher net worth for households that are working with an advisor compared to those that are not. Another common theme that I see in the healthcare industry is your careers are some of the more demanding ones, never mind the last 2 years. I think all the time you're just pulled in a lot of different directions. And so even some of the best intentions, have finance as a priority. We all know things can fall to the wayside. And so when you've got, like someone on your team who's a second set of eyes for you, they should be able to support you, let you know about changes. Things are going to be relevant to your situation. And a really important part is understanding your situation. So they know, not everything you see in the media and in the news is going to apply to you. We learned that a lot while Trump was in office down south. There's a lot of headlines and a lot of panicky clients that were not necessarily needing to panic. So just having someone to basically that you trust, that you can communicate clearly with, who's going to keep you on track. I'm just going to start my timer here because I forgot about that, and I want to make sure I stay on time. So one of the first things that I was going to touch on today, because this is healthcare, was the changes to the CP-RSP matching. So I know it used to be you had to always rush and make your RSP contributions in at a certain time so that you had your receipt in time for the deadline to submit to the college to get the matching program. They have updated that in the last few years. So I believe it was 2019, you can now log into your account on the college website, and you have the option of actually claiming those dollars for your RSP or for your tax-free savings account. If you haven't done that yet, while you're logged into your account on the college, they actually have a really simple, great YouTube video that shows you exactly what to click on and how to do it. They've also changed a little bit of how it's entitled. So there is your standard benefit that's basically based on income if you hit a threshold based on your fees for service. And then there's the length of service benefit as well. That's just based on your tenure. So those are kind of the key components and the key changes. So if you haven't done that yet, don't be freaked out. Literally, you just log into the account. The YouTube video is less than 2 minutes. It's very easy to do. I'm sure you can handle it. Hopefully you have an advisor in your world who's said, oh, by the way, don't forget to log in this year and make sure that you're getting those benefits. The change to go from RSP matching to have the option to use the TFSA is the second piece that I did want to touch on as well, because that's new and you didn't always have the option to claim those in a TFSA. So I've had a few questions from healthcare clients about, what one should I be picking? Should I be using the RSP or the TFSA? And this is great company to ask that question in, because I think really it comes down to a lot of tax strategy. We know the RSP contributions are directly tax deductible against your taxable income for that calendar year, whereas the tax-free savings accounts are not. So my answer is always, well, we need to get your accountant involved as well. The RSP strategy, it's going to be taxable in the future. So we have to be aware of that, knowing what future incomes you have coming your way. It can be something where we might default to a TFSA in some regular income years if we know we've got a big gain. We have seen a lot of real estate sales over the last 2 years with the impact we've seen on real estate markets. Got quite a few clients who've been in the area for a long time cashing out at these high values because they can get more than they ever thought they would. So we're seeing a lot of turnover, and those transactions are leaving a big capital gain, which can push you up, into a new tax bracket, or if you're already at the top of the ladder, make you feel like, oh, was it even worth it? I'm paying so much in taxes selling this building. RSP is a great strategy to save that room and potentially use it as a way to mitigate some of those big tax years when you've got some of those big events that are potentially going to impact your situation. The other great RSP question is a spousal RSP question. I do deal with a lot of kind of dual income, dual healthcare couples, you know, romance stories out of med school. But we also have a lot where there can be very, you know, in a different role, maybe they're in a totally different tax bracket. There's absolutely some valuable opportunity there to do some planning as a household when we've got two spouses. There's some things that you're eligible for and some things that you're not. So understanding in your situation when you should be using some of those spousal strategies if you're in different tax brackets. It's another thing that your financial advisor will help you navigate. And yeah, the tax-free savings account is never a bad idea. There's no taxes there forever. Ultimately, when you retire, you all have no RSPs and huge TFSAs, and then you'll never pay taxes ever. So that would be, you know, a great goal for everyone to lay out. But definitely, I just wanted to touch on some of those basics. Individually, you probably have questions that you want to understand that apply to your situation specifically, but just a little bit of a highlight there because the TFSA is a new option that you haven't had previously as you claim those benefits. I did want to talk about fees because I get so many fee questions from the healthcare sector as well. And I find, in my opinion, the fees debate at the core is a debate between active management or passive management. Also looking at, you know, do you use a fund manager? Do you pay somebody a percentage, have that advice fee on there? Or do you go into something self-directed or kind of like a robo-advisor solution? So, I mean, everyone's going to be different. And really, when you're looking at a passive strategy, your fees are going to be lower because you're just tracking the market. You're looking to kind of mirror performance in a certain sector or a certain geographic region. You haven't got someone who's trying to create an alpha value where you're getting kind of better than average performance on that. We do know when we interview kind of general savings rates and performance rates that most people have a rate of return of about 4 to 6% on average. Markets actually return 8 to 10% on average. So we know that there is a difference there between what the average person is getting. In my experience, also remember I started my career right before the global financial crisis. If you're not getting the same returns as the market, it's probably because you're cashing out at the wrong time. It is like #1 pitfall to try and avoid, and probably, I think, one of the most valuable assets of having a trusted financial advisor who you will listen to, not someone just to yell at when markets are down, but one that will actually give you confidence to maybe stick it through. When we see people pull out of down markets, it's the hardest way to kind of recover funds and just to undermine all the savings efforts that you've done so far. So again, looking at this active versus passive, the self-directed versus having an advisor, different value at different stages. I think in the active management strategy, you know, you're really looking at market efficiency, which is how efficient is that market. So we look at the US, it's a very efficient market, heavily regulated, very transparent. You can get all of the information. It's reliable from a lot of those stocks and companies. Very different from the Asian market. If you look at some of the reporting coming out of there, it's not all trustworthy. It can be harder to find. You know, those are two very different markets where I would argue an advisor or professional management with a lot more value and ability to create that alpha or above average performance in like one of the Asian markets compared to the US market, which is really hard to beat. You're also going to look at your portfolio construction. This is where we would get into the kind of nitty-gritty of financial planning because all of the accounts that you have are taxed differently. So you'll have your RSPs or TFSAs wherever you've got your college kind of savings going. Those are taxed in totally different ways, where we've got the TFSA is like the never, never tax, whereas the RSP is the save now, tax later. And then we have your corporate tax and then your personal tax. So each of the account structures are taxed differently. Each of your sources of income are also taxed differently. So if you ever, you know, look with your accountant, you'll see there's, you know, your other income. When you look at marginal tax rates, there's whole other columns for capital gains, eligible dividends, non-eligible dividends. So part of your portfolio construction with an advisor would be matching up the type of investment with the type of account with your own personal plans. That's, I think, really the heart of some of the value that we offer. And then the other thing that would help you navigate the decision on something self-directed or something more actively looked after would be the historical performance. So you can look at something and look at the history, see how it's performed and set your expectations that way. That can be a little challenging now because there are so many new things hitting all the time. Like, well, Simple's constantly coming out with new things. You know, my bank has just come out with a new self-directed platform, and so you don't have the history there necessarily to compare to, but you know, doing some research to set some realistic expectations there is definitely valuable. Last thing I wanted to touch on is, you know, people always ask, what should we invest in? Didn't want to go through like a full market update, but we've seen a lot of headlines recently. I don't want to be the investment person who doesn't talk about, you know, what you should buy. The most recent headlines, we've seen a lot of news on inflation. So in Canada, inflation rates have kind of come out about 4%. In the US, they came out a couple of weeks ago up about 6%. This is really high. When we take a look at interest rates, they're extremely low. We've never had lower interest rates. We're actually up a little bit from the bottom. Mortgage rates at the bottom, we're tracking around 1.69. They're currently tracking around 2.69 on average. Don't quote me on all these numbers, but that's very close to what is real out there. If you take a look on the old Google machine, when you're looking at these, you know, things and looking at what is impacted, you want to understand how that's going to impact your portfolio. So some of your things will be impacted and some won't. We want to look at banking restrictions we've had in Canada during the pandemic. There have been a lot of restrictions on what banks can do as far as their lending as they grow their capital and money on deposits or assets under management. That hasn't all translated into new lending. There's been a freeze on dividends for banks in Canada. They haven't been able to increase those. Those are being lifted. So we're seeing some positive forecasting kind of hit the financial industry here. COVID is not hitting all areas the same. We're kind of coming out of it very much in North America. There are sectors, obviously travel and hospitality, and areas of the world that are still going through their COVID recovery. So we would expect those areas to see, there's my timer, going to stop after this, but those are the areas we would expect to see some of the amazing growth that we've seen in North America over the last 18 months should be coming out of some of those high impact COVID areas going forward. So on that note, I hope you grabbed some food for thought, but thank you so much.
Awesome, Greta. Thank you so much for that info. So you touched on fees. Can I ask about advisor compensation? So within the industry, how does that typically work for a managed portfolio?
That is a great question, and I hope that any advisor you're working with would be able to answer that kind of clearly and concisely. The truth is the fee structure is very different. And most of the main banks, the banks are paying their advisors. The advisors aren't earning a commission or an income directly from those accounts on a regular basis, which is the opposite of the brokerages. So when we're dealing with a brokerage or an investment advisor on that side who's got, you know, a full market license for your stocks, for your bonds, for your mutual funds, for your ETFs, whatever you've got, they're generally charging you an advice fee, and their income is coming from that advice fee. So it depends on what they're getting as far as what they're managing. Also, the different options can pay them a different rate. So they could potentially be getting paid more to sell you a mutual fund than an ETF because the fees are lower there. So you do want to understand where the advice is coming from, just so you're aware if there's a potential conflict there, you want to kind of know where it is. But it is a great question to ask your advisor because they are not all compensated equally.
Awesome. Well, thank you so much, Greta. So now I am going to pass the floor on to Alana.
Hello, I'm Alana McLennan. I work here at MNP with Curtis and Marley in our tax specialty group, and I work with a whole variety of different kinds of clients, but I do support our professional niche and the clients that we have as physicians and dentists and veterinarians and all other sorts of professionals. So I wanted to touch on a couple of things. You know, one of the most common questions we get, and some of the most common pitfalls we see from the accounting and tax advisor side of things. So one of the most common questions that we get, and not just from physicians, but from a whole host of various different kinds of clients, is should I incorporate, and what are the benefits of incorporating? And oftentimes they ask, you know, is there a certain threshold of revenue where it starts to make sense to incorporate my practice? And the answer for that, as with most tax planning, is it's really going to depend on the individual's specific set of circumstances and their situation. One of the biggest tax advantages to incorporating can be tax deferral. So a corporation is a separate entity for tax purposes. So if you incorporate your medical practice, that means you'll essentially be paying tax at two levels, the corporate level and then the personal level. And the way our tax system is structured in Canada is the intention is that if you earn the income personally, or if you earn it in a corporation and then you flow those funds out to yourself personally, that you'll be on the same playing field, so that you'll be paying the same tax rate overall as if you had earned it just personally. And that's called integration. But there is a significant corporate tax deferral available if you earn that income in the corporation instead of earning it personally. So the corporate tax rate for income up to $500,000 in a corporation is only 11%. If you compare that to the highest personal tax bracket in BC right now, it's sitting at 53.5%. So 42.5% basically deferral advantage if you don't need to pull out the cash from your corporation and use it personally. So our answer to that question is, it's often if you're earning more income than you need to live off of and to pay off your personal debt, then maybe it's time to start looking at incorporating. Some people are more debt adverse than others. So some want to, if they're straight out of school and or they have other personal debt, they want to pay that down as fast as possible. So if you're pulling all the earnings out of your corporation anyway, and you're not going to be benefiting from that tax deferral, then perhaps incorporating isn't quite in the books for you quite yet. Other people are happy to have that debt sit out there, and they're more than happy to keep the savings within the corporation. And so incorporating may be more beneficial to them at that point in time. And that deferral lets you also save up for retirement faster if you're investing in the corporation and keeping the money in the corporation, investing there instead of pulling it out personally and paying that 53.5% tax bracket. Basically, if you're as a quick example, if you earn $200,000 of income, if you earn that in personally, you'd be paying that 53.5% tax, assuming you're at the high rate, leaving you with $93,000 after tax. And if you're in that incorporation instead, you paid yourself a salary of $100,000, you'd pay personal tax on that salary of $53,500, and you'd be left with $46,500 in your pocket. And you'd be taxed at $100,000 in your corporation. So you'd earn the $200,000, but you paid out $100,000 in salary, and you'd only be paying $11,000 tax at 11% in the corporation. So at the end of the day, combined between what you have in your personal pocket and what you have left in the corporation, you're looking at $135,500 compared to $93,000. So you got that $42,000 extra in the corporation that you can then invest within the corporation, and obviously having that cash up front to invest, you're going to earn faster on that. So that's the most common question I think we see from an accounting perspective. One of the most common pitfalls we see for clients that are incorporated is, and Curtis alluded to this at the beginning, is not staying on top of those corporate tax payments and ensuring there's sufficient cash flow for those payments. So it is a separate entity for tax purposes. So along with that comes a whole host of additional filings and payments that may be required. So making sure that that's planned out ahead of time so that there's no surprises come the time that you need to pay for those taxes or the time that those filings come into play, and then starting to accrue interest and penalties, which no one ever wants to have to pay to CRA. So there's likely, if you are incorporated, there's likely going to be monthly corporate tax installments that are required. So the government wants those paid out over the 12 months rather than at the end of the year. And then in addition to that, if you earned more than you did in the prior year, there may be additional taxes owing at the end of the year. Then those are due 3 months after the corporation's year end. So that timing can vary depending on when your corporation's year end is. So it's not going to be the same as when your personal taxes are due. If you're taking a salary from the corporation, there's going to be payroll remittances required, CPP and income tax, and those are due on the 15th of the following month. If you are taking a salary or if you're paying yourself in dividends, there's T4 and T5 filings required, and those are due February, the end of February for the previous year. And similar WorkSafe BC payments, those are due in February, early March of the following year. So there's a lot to keep track of and a lot more to think of than if you're an unincorporated practitioner. So the best way to stay on top of this is usually to put yourself on a monthly compensation plan, and your advisor can assist you in scheduling or looking at a compensation plan that works best for you and makes the most sense for you personally. Setting up automatic transfers for your various payments, for your payroll remittances, your corporate installments, those sorts of things. Some people still do post-dated checks if that's what you're more comfortable with, but setting up those automatic transfers, setting up the transfers to pay yourself your monthly compensation so that you don't have to worry about falling behind on any of those payments. And then your accountant should be sending you those reminders for the corporate tax filings and T4 and T5 filing due dates to make sure that those are filed on time so that there's no penalties incurred on those. So obviously there's a lot more to keep track of when you're incorporated, but there can be benefits like the tax deferral. Having a trusted advisor can help you make sure that you're not finding yourself in a situation where you do have to pay those penalties and interest payments to Canada Revenue Agency, which no one wants to have to do.
Great, thank you, Alana. I just wanted to, so you touched on kind of the stage of career when you're making that decision to incorporate or not. Let's say, so we have a doctor incorporates, jump forward to looking to retire, and now they have this corporation. What exactly, just kind of an oversight, what needs to happen when a physician with a corporation is looking to retire?
Yeah, for sure, good question. So the corporation can still exist. So there's no need to wind down the corporation immediately. If you no longer have a medical license, there will be a deregistration required with the college, but the corporation itself can still exist without any immediate tax consequences. So if you've been saving up for retirement within the corporation, you probably don't want to dissolve that company right away, because you'll potentially take a tax hit on that when the cash is pulled out personally and pay tax on it personally. You know, it's going to depend again on everyone's individual structure, but looking at that cost benefit analysis of is it worthwhile keeping the corporation around, paying the annual filing costs related to that, the corporate tax returns that are kind of those annual compliance that you need to continue to file, versus winding it down and potentially paying a tax bill now. So just weighing those advantages and the tax advantage deferral. Another thing to be aware of is that income splitting is available with a spouse once the physician shareholder has reached the age of 65. So that is a benefit of keeping it around, is that we can potentially split income with a spouse, and they may be in a lower tax bracket and access those marginal tax brackets, and then draw the income down gradually out of the corporation over time so that it's not all coming out at a high tax rate.
Awesome. Great, Alana. Thank you very much for your presentation there. We are going to move on to our SB analyst of the evening, Nathan Seward. I'm going to kick it over to you and you can take over.
Hi, everybody. My name is Nathan Seward. I am a lawyer at Heath Law, and I practice mainly in the areas of corporate, commercial, estates law, and real estate law. So, Alana, thank you very much for talking about corporations, and in particular the tax advantages and tax impacts of a corporation. And there are a lot of issues about incorporating from a legal perspective also. And we get a lot of questions about incorporating too. So there are three main reasons why you might want to incorporate. And the first one is generally what's known as limited liability. As Alana pointed out, the corporation has a separate legal existence from the shareholders. And so the corporation can own property, it can sue, it can get sued, it can do anything that a person who has capacity can do. So oftentimes people like that separation between the corporation and the individual because there's what's known as the corporate veil. So the corporation can be held liable and a shareholder might not be. The second reason is as long as you are doing your corporate filings, the corporation can have a perpetual existence. So shareholders can come and go, but the corporation will continue to exist. The third reason, and one of the biggest ones, especially for physicians, is going to be because of these tax advantages. And so this is why you'll speak to your accountant and they'll tell you to speak to a lawyer about incorporating, or vice versa. You'll speak to your lawyer and say that you're interested in incorporating. And then something that we'll do is we'll have you speak to your accountant just to make sure that it makes sense from a tax perspective. So I'm just going to hold up a little diagram and see if this works. So this is like business associations in second year at law school. And this is exactly what my business associations teacher used to draw out. The corporation is like this nebulous little guy who has this separate existence from human beings. Always happy, of course, because he or she or they contribute to the greater good. And we've got shareholders involved in these corporations. And these people have various bundles of rights. The 3 minimum bundles of rights they need to have are to receive dividends, to receive part of the company on dissolution, and voting rights. And what shareholders do with their voting rights is they vote for directors, and the directors then appoint officers. Some of the main officers that we all know about are chief executive officers. And these are just people who've been delegated responsibilities by the directors, who themselves have been voted in by the shareholders. In a roundabout sort of way, that's like very, very big picture sort of way, that's what's happening with a corporation. So things that you should be cognizant of in terms of incorporating if you are a medical professional. Well, number one, your name has to take a certain form. You have to have your credentials in there, so doctor or MD or something to that effect, which shows that you're a doctor. You need your name in there. Typically, I believe it's your last name and your initials or your full name, and then you need a corporate signifier. You need something that signals to the general public that you are in fact acting under a corporation. And that's where you see these suffixes like limited or LTD or corp or inc or incorporated. And that just signals to the general public that they're dealing with this separate legal entity who's different from the shareholders. The next thing is your corporation is going to have what are called articles, and your articles are essentially the constitution for the corporation. They generally take a certain form, but when you incorporate as a medical professional, you do need to have certain provisions in the articles which say that you are going to conform with certain provisions of the bylaws, of your bylaws, and certain provisions of the Health Professionals Act. Those need to be in your articles in order for you to have your medco. The other thing too is you need your consent of the college. I mean, typically you'll be aware of that and you'll be getting that. Right now, it can take around, well, it's taking 1 to 2 months typically, not too long. Some more advanced corporate matters are taking a little bit longer. So in terms of pitfalls, some of the pitfalls, we've spoken about the name, we've spoken about the articles, your corporate filings. You need to make sure that you're doing your corporate filings annually. Now, this is filing with the corporate registry saying that you have typically, a corporation generally is supposed to have an annual general meeting, or it can waive the annual general meeting. You're going to be reporting, or your lawyer is going to be reporting that the meeting has happened or it's been waived. You need to keep your corporate record book up to date. So the directors theoretically, well, they certainly should be consenting to act as directors, but there should be a written record of the consent in the corporate record book. Legally, actually, unless all the shareholders waive the requirement to have an auditor, then the corporation should be audited. Well, should hire an auditor to do the auditing rather. And these are just some of the considerations. So your name, your articles, doing your corporate filings, and keeping the record book up to date. Those are the main things I would have to say in terms of incorporation. I'll open it up to any questions. Any questions?
Yeah, great points, Nathan. Just kind of looping back on some of those corporate filings and items. What sort of things do you need to document with regards to the year end from the legal standpoint, just to keep your annual filings and minute books up to date?
Well, I mean, the things that we would do typically is we have the directors, they consent to acting as director from time to time. They consent to everything that the corporation, well, the shareholders, that is, will consent to everything that's been done by the corporation for the past year. They waive the auditor. They approve the financial statements. These are sort of the main things that go into the corporate record book in terms of filings every year. And then, of course, there is also there's the filing with the corporate registry.
Awesome. Great information there, Nathan. I think, did you have anything else, Nathan, or should we open the floor for
I can go on and on about leases and other things like this. So I figured I'd just touch on incorporation, and if there's any questions, then I'll just make myself open for that. So
sounds good. Yeah, some other things that we kind of saw on the legal side of things is when would you kind of come in on cost share arrangements, and would you be involved in setting those up? And what kind of things would you see from that side of things?
Well, I mean, yeah, certainly. The lawyer becomes involved in the cost sharing arrangement anytime that there are costs to be shared. So provided that at least two doctors are going to be in a relationship, that is probably a good idea to have a cost sharing agreement to say exactly how the costs are going to be split up. So anytime I'd say there's a relationship, that's when the lawyer comes in there. In terms of some of the different things that we're seeing in these, I mean, staff, I understand, is probably the biggest expense. There's different ways. I mean, who's going to be paying for what amount of the staff's time? If one doctor is using more staff and using more time, then probably the doctors don't want to split the staff cost 50-50. Supplies, consumables, these sorts of things. Share of the cost of the lease space. So if one doctor is using more square footage than another doctor, if the doctors are using essentially they're sharing all the lease space, all the rooms, and going back and forth, but someone's there less time maybe than the other doctors, maybe they don't want to pay quite as much for the lease space. So these are some of the considerations.
Great. That's awesome. Yeah, so it's kind of on a cost share by cost share, depending who you're going into a cost share with. You can look at your whole scenario.
Oh, absolutely. Yeah, I mean, I would say there's no one size fits all for this sort of thing.
Perfect. Awesome. Thanks, Nathan. Very great info there. I think maybe at this time we'll just open the floor for any questions for any three of our presenters, and we can kind of just shoot around some questions and have some discussion and see how the three kind of panelists as a team can, step in and act as that professional team behind you. So
sorry, there is a question from Sydney in the chat box there. I'm not sure if you guys can read it or if you want me to.
Yeah, I can step in there and take a look at that one. So the question is, corporations continues to exist. Is this better, easier for families in estate planning? And then the second part of that is, what physical or virtual form does a corporate record book need to take?
Good, great questions. And yeah, so it's the corporation, the language I'd probably use is it has perpetual existence. And so one of the advantages is that it can be used as an estate planning tool. The way in which it might be used is that, okay, you can draft a will, and there are some of your assets that are going to need to go through probate. So for example, real estate will have to go through the probate process. Most money in banks, over about $25,000, if there's not a designated beneficiary on any registered accounts, those funds in a bank will need to go through probate. Guns, actually, believe it or not, which are subject to a gun registry, and vehicles, just about any property that is that's subject to some sort of registry or government agency, pseudo government agency like a bank, those are usually required to go through probate. And it's because the probate process is the court certifying someone's will is in fact their last will. You know, the Land Title and Survey Authority, all the other registries and banks I've spoken about, they want that sort of assurance. They want to hear something to the effect of, okay, like the court said this is the will, so this person who's purporting to be executor does in fact have these powers under the will, things like this. Now, what you can do, a fancy estate planning trick, is you can avoid probate sometimes by, if someone doesn't have a will, for example, and there's another shareholder, or if they do in fact have a will, but it's restricted to this corporate entity, then this executor, pursuant to the terms of this will, can sometimes come in and not have to go through probate and take control of this corporation. And the reason why you might want to avoid probate, the two big reasons are because it's a somewhat cumbersome process. It can take a little while, cost some money, and there's probate fees involved, 1.5% probate fees. So by circumventing probate, you can actually not have to pay these fees and not have to go through this cumbersome process. So it can be an effective estate planning tool, but I mean, better, easier, there are a lot of different considerations. So that's what I'll say, effective estate planning tool. Your corporate record book can take either a physical or a virtual form. So it can be either electronic or physical. More and more, we're moving towards electronic corporate record books. The bare minimum things that you usually have in your corporate record book, you have your incorporation documents, your articles of incorporation, your certificate of incorporation, your incorporation agreement. You'll have your actual articles in there. You need what's called your Central Securities Register, which is the register of the shareholders. You need the register of directors, which shows who the directors are. And then there are a number of different tabs which show resolutions by the directors, resolutions by the shareholders. You'll usually have something in there if there's a shareholders agreement. And yeah, that's what it looks like. It's either physical with a bunch of different tabs, or it can be electronic with a bunch of different subfolders.
Thank you,
Perfect.
Nathan.
Yeah, great answer, Nathan. Sydney, did you have a question, and then we'll loop back into the chat for another one?
Oh, no, I was just saying thank you for the answer. Okay.
Perfect. We did have another question come in, and I think this one kind of builds off the first question that you had there, the first question, Sydney. So the next question is, upon retirement, can one turn the corporation's money into a holding company, so it's personal money? One of their accountants suggested it a few years ago, wondering if that's still done. So I will leave that to Alana. I think would probably be best to discuss that.
Yeah, absolutely. So like I mentioned, when you retire, the college is going to want you to change the name of the corporation so that it's clear that you're no longer a practicing physician. So a numbered company is often used because there's no name reservation required for that process. You could use a different holding company name and go through the process of requesting that name. So it's either a numbered company or a, oftentimes people make up fun holding company names, whatever works, but that money is still corporate money in the corporation. So once you start pulling that out of the corporation, you'll pay personal tax on that. But the benefit of keeping it in there, like I mentioned, is that tax deferral and that the ability then use those marginal tax brackets if you pull it out over time, if you don't need all that money immediately. There may be some other planning opportunities, and I'm not sure maybe if that's what you're alluding to as well. If someone suggested a holding company that potentially where there's preferential rates, that tax planning does still exist. So I'm not sure if that's what you're alluding to, or if you're just kind of alluding to the change in the name of the company to a holding company. But it is still corporate funds at that point in time.
Great answer, Alana. So kind of, so to speak, you can have your pot of money, what it sounds like, in your corporation when you stop practicing. Say you've accumulated $1 million in wealth at that low corporate tax rate. So then essentially you would pull that down kind of over time to make the best use of your personal tax rate. Is that kind of what you're saying? Yeah.
Yeah, exactly. Yeah, rather than paying it all at 53.5% if you put the $1 million all out at once. Yeah.
Perfect. And then I guess the flip side of that, Grata, then that money can still be held in the corporation, and you can invest that and kind of come up with strategies for that to earn some portfolio in the corporation and grow the corporation's wealth. Is that correct?
Absolutely. And just what a beautiful example of why you need a full team of professionals kind of supporting these decisions. The language that I often use is, your whole co or the transition of that corporate money. It's almost like another RSP, because the taxable event happens when you take it out of that account and like bring it into the personal side. And that's where you need to have the advice in place to make sure that you're marrying those two things. So when we look at the RSP planning, that's something we want to keep in mind is, where is your wealth building? We often, because of those low corporate tax rate, see the wealth accumulating in these corporate structures in the background. Those are going to compete with your RSP withdrawals in the future for your total income and potentially define what your tax bracket is going to be through your retirement. So again, you definitely want your team to know each other. You want your finance guy to know your tax guy, to know your legal guy, because I mean, the finance guy and the tax guy feel biased to a lot of magic happening there. But we can't even get started if you haven't been in to see Nathan and get all of your stuff set up. So, just the dream team at work over here.
Awesome. Great points. Did anyone have any more questions? You can pop your mic off mute or pop it in the chat. Looks like we got another one here. Often wonder if it's just myself who gets glassy-eyed as soon as I hear words like RSP, TFSA, dividends, taxes, or dollars. Is there a recommended strategy for out of sight, out of mind investing within a corporation? I think that's a very good question, and I think can be considered kind of a two-part question. So maybe Grata, you can kick it off on the investment side and how that looks in the corporation, and talk a bit about the personal RSP TFSA, and then maybe we'll shoot that over to Alana to maybe discuss a bit on how that looks from the tax side.
Absolutely. You're definitely not the only one who gets glassy-eyed. I often have to remind my clients, like, hey, are you still with me? You'll get an advisor who's very passionate. But in all seriousness, you want to understand the language your advisor is using. You don't want to be glassy-eyed, just like showing up at the bank to put in your hour for the year and not understand the language that they're using. That is not doing you any service at all. So you do need someone that you can communicate with. I had an experience when I was just starting out with a very senior person, talking more on the lending side to different strategies between corporate and personal. And the guy sat there nodding along the whole time. Yep, okay, definitely glassy-eyed. And at the end of the meeting, I was a brand new trainee. He came up and he's like, hey, what's the difference between a loan and a mortgage? Why did he keep talking about loans and mortgage in separate categories? And it's like, wow, you really need to know where your clients are at, because we speak a different language in finance sometimes, and definitely guilty of overwhelming people. And that's not good. There needs to be more transparency there, and you need to be able to educate yourself and understand the advice that you're getting, so you know how it applies to your situation. There are ton of resources out there. If you're getting glassy-eyed at those words, though, you're not going to like the resources because they're full of them, and it's more boring to read them than have someone tell you about them in most cases. But the strategy for avoiding it is building that trusted team. So there are different levels of service on the finance side. So you can have, a full service advisor. You want to understand what's their reach, what's their breadth. The banks focus a lot on GICs and mutual funds. You're going to get brokers who will focus on managing platforms that kind of marry mutual funds, ETFs, and stocks exactly into different kind of accounts for you. And so I would say the more you get them to communicate with your accountant and your lawyer, the more they're going to be able to do that legwork and heavy lifting for you in the background and say, hey, I've talked to Alana, I've talked to Nathan. This is going to be a really efficient, solution for you. And this is what I would recommend. And this is why. And then you take that work and all that time to try and educate yourself on the investment side of it. You take that off your plate. You got enough on your plate.
Some great, Grata. I have very good information there. Yeah, maybe Alana can maybe jump in and speak a little bit about dividends, taxes, and maybe even a bit about employment income, because that's kind of a bit of a question that's always out there, and I think coming a little bit from the question that was just asked as well.
Yeah, absolutely. Yeah, I think those were all great points, Greta. I mean, that communicating, oftentimes we communicate directly with the investment advisor on getting the information we need when we're preparing corporate tax returns and personal tax returns. So that's kind of the out of sight piece I think you're alluding to there, Philip, is that, we can communicate there, and you don't necessarily need to be involved on that side, but it is important to understand your plan that you have in place. And one of those things that we do, discuss with clients is that compensation, that personal compensation if you are incorporated, because if you're incorporated, you can then compensate yourself either through a salary, which is taxed as employment income, or through dividends, which is taxed at dividend rates. And there's different benefits to each salary and dividends, and it's not going to be a one size fits all strategy. There's going to be considerations on whether you want, if you are contributing to your RSPs and you want to create RSP room, a dividend is not going to increase that RSP room. If you, there's certain deductions on your personal tax return that can only be claimed if you do have that employment income versus dividend income. But dividend income is often simpler, then you're not required to make those payroll remittances, that CBP and the income tax. So a whole host of considerations. There's a lot more out there, but that can be discussed with your advisor, and then obviously we bring in the whole team and discuss it with the financial planner, make sure that fits the strategy as well.
Perfect. Thanks, Alana. That was really good information, and really interesting to hear how the whole team works together.
Can I just say something quickly too? And I think in a situation where you're having these conversations with, like, your advisor, your lawyer, your accountant, and it's going like this, yeah, that transparency, we're happy to, shift our verbiage, just kind of spend some more time to help you fully understand, because we do value and think it's very important that you do understand and see the value in what we're doing and what we're setting up in that sense for you and your business and personally. So yeah, please make sure you do clarify with your advisors that, hey, can you just kind of, slow it down a little or explain it a little bit better that I can understand.
Yeah, absolutely. Great point, Marley. And sometimes even draw a nice picture like Nathan did for us today. So that can also make it super easy to understand. Wanted to say thank you to our panelists today, and thank you so much for taking the time out of your busy schedules to come in and hear us speak and hang out with us for a little bit. I did see that. Is there anywhere to get more resources or where you can learn more? I'm going to get Marley to put up everyone's contact information. As was kind of mentioned, everything is very personally tailored to each individual's needs and an individual basis. So chatting with a lawyer or tax advisor or a broker can help determine your own personal goals for yourself or for your family, as we can see on the screen here now. So I'll get Marley to just put up the contact information, and I believe that is also going to go around to everyone as well. So now that we have that information up there, there's all our pretty faces as well. We shall kick it back over to Katrina and see who's going to win the lovely Vancouver Island gift box.
Thank you very much, Curtis and Marley. I know you guys have also prepared a wonderful gift basket. I think Marley has it there. So I don't know if you can see that there, but we're just going to do a bit of I'm going to share my screen now and do a spin the wheel for the lucky winner. So I think I have everyone's name in there. If you don't see your name, quickly shout now. But okay. Oh. Congratulations.
Congratulations.
Deanna. Okay. I will be in touch with you as to how we will get that to you. And then I also just wanted to thank our guest speakers and to Marley and Curtis for facilitating and also for providing dinner for everybody. I'm going to try and stop sharing my screen now, but it doesn't seem like I can. Yeah, I'm not entirely sure why I can't get rid of it. But anyway, yeah, thank you, everyone. And then we'll see you all next time at our next session, which will be January 26th. And then there'll be, I believe, monthly from then on out at the last Wednesday of every month. There you go. Sorry about that.
Perfect. Thank you so much for having us, everyone, and for showing up tonight and listening to us talk. We really appreciate it. And we hope to see you guys at the next sessions starting January. Different topics, so hopefully they're interesting to you and you join us. So thank you so much.
Thank you.
Thank you.